Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today, Abhay Agarwal of Piper Serica. And from the last time, if viewers would remember, a relatively cautious Abhay Agarwal. Abhay, great having you. Thanks for taking the time out.
Thank you, Neeraj. As always, lovely to be on your show and being able to talk to you and your viewers through the show. So thank you for having me.
Pleasure is entirely ours. Abhay, the last time that we spoke, you were cautious. Since then, some water has flown under the bridge. But if anything, the geopolitical situation has become even more tense. And while people are only looking at Israel Hamas, at the other end, what's happening in the South China Sea, Russia, etc., all of that is starting out to become a bit of a pot boiler. What's your sense on risk assets thereof? Are you even more cautious than what you were the last time?
Well, I think if I was to look at it from the weather analogy, I think we have an orange alert. We are not in the red alert zone yet. But I think we are getting there. I think there is the interesting thing, Neeraj, you would have seen is that there are a lot of people, big fund managers, calling out for cautious around the world, being defensive, saying that look, S&P and Nasdaq and emerging market stocks have run way ahead. In an environment where the yields, short term and long term in US are rising and are at multi-decade high now, and they're not stopping. So every time they get softer, again there is something that takes them to a higher level. So looking at that construct, it is difficult to definitely be aggressive, and I think we continue to hold our defensive stance as far as the portfolio is concerned. Uh, and what is happening around us, I think there is a large set of investors who still believe that they can exercise their put on the Fed, which means the Fed will at some point of time come in and bail out the markets by cutting rates. My worry is that that is not probably going to work this time, because this time there are no buyers or very few buyers of the bonds or the debt that US government issues. Look at China. China has been selling its holding of US treasuries. A lot of emerging market countries are selling the
Japan
US
is doing
bonds.
so.
Yeah. So absolutely. So I think that is what is happening. That in that environment, even if Fed was to cut rates or call a stop, I think the cost of capital for Fed will keep going up. So in an environment like that, the only bright spot could be earnings. We're just into the earnings season. I would say so far so good. IT has disappointed. Uh, but other than that, it will be good for investors to be cautious over the earnings season and see where the opportunities are and have some cash in the portfolio.
Got it. Abhay, could things get a bit more tricky? I heard you say that we are not at red alert zone as yet, but we are getting there. So, what could tip us from an orange alert to a red alert?
Well, it's always, Neeraj, as you have seen something from the left side of the field which you have not imagined, that leads to a sharper correction and creates the complacent mood that the markets get into. So it could be, again, I'm just guessing. I'm not calling for a correction. I'm no market expert, but it could be again like SVB got into trouble when the rates were even lower. It could be a bank or a couple of banks or hedge funds getting into trouble and then starting a chain reaction that will then tell investors how fragile this whole investing ecosystem is, and the people who are long with borrowed money are the ones who are most fragile. So I think that happens as a sudden instance. It's not predictable. I think none of the corrections, frankly, are predictable. None of the sharp rallies are predictable. We saw a sharp rally starting from April 1 this year that nobody could predict. So similarly, it is difficult to call for a red zone event, but typically I've seen it is like going back to 2008 and there onwards. It's typically some financial institution putting up his hand and saying, "Look, bail me out. I am not liquid anymore." I think we are getting close to an event like that.
Okay, what about What about the broader end of the spectrum? That seems to be racking up new highs every third day. Now, if you're cautious at large, are you cautious at the broader end of the spectrum?
Uh, Broader, do you mean the smaller and mid cap stocks?
Yes, please.
Well, yes, I think we have had a phenomenal rally in that space in last 6 months. Since April 1, we have seen a rise of almost 40% in absolute terms. And mid cap and small cap indices that had underperformed the large cap indices for more than 5 years finally caught up. And I think a lot of that happened because the domestic mutual funds that focus on mid and small cap stocks got a lot of very good flows. And investors, the retail investors, kind of looked away from large caps finally and said, let's see if there are interesting ideas in small and mid caps. So I think we are largely done with that rally. I think whatever easy money was to be made in the mid and small cap space has been made, and now it will be which companies will actually continue to perform as per the investor expectations that will continue to get flows. Uh, the problem with that space, Neeraj, is that there are just too many companies, and it's very difficult to call out winners on the basis of relatively lower data points. I personally think that space will do very well over 3 to 5 years, but I will caution investors that look, that is not a space that you want to trade in or get into stocks or schemes that are very attractive suddenly, and you may be late to the party. But it is a place that you need to have 3 to 5 year holding capacity and not trade in and out. I think that space will do well, but I think at this point of time the valuations are looking unfavorable to us.
Okay. But so sometimes valuations or steep valuations are a factor of uh, the future growth being predictable, being high, and being long enough, right? So my question is, are there pockets out there, Abhay, wherein you believe a combination of these things are present, which are leading for some individual themes to be stretched maybe in terms of valuations, but still palatable?
No, absolutely. I think Neeraj, if I can rephrase what you just said, there is always a bear market and a bull market going on simultaneously in all equity markets. So there are themes, and as you would remember, we are thematic investors to that extent. Like last year, we had picked up small banks, NBFCs, microfinance companies trading at very low valuation, and as you rightly said, we thought they're trading at an attractive valuation compared to their long-term growth expectations and the quality of business. And that theme has done well. A lot of them have got re-rated over the last 6, 7, 8 months. Then we looked at textile apparel exporters as a theme, and that theme has played out very well for us. So similarly, I think there are spaces that we are looking at. One of the big ones is agrochemical space, or actually beyond that also, not just agrochemicals, but companies that make farmers more efficient by crop protection, crop increasing the yields of the crop through fertilizer, specialty chemicals, farm equipment, uh, lending to farmers. I think that space has been neglected by the markets for a very long period of time, and rightly so. We didn't see any pricing power. China has been dumping a lot of specialty chemicals along with commodities in the global markets, leading to very low pricing power. Uh, and it is still difficult to call when the cyclical bottom will form. But the interesting thing, Neeraj, there is that a lot of these good companies in mid and small caps also are available at same price that they were 5 years ago, and they have grown. So the multiples are now close to almost single digit if you adjust them for the cash on the books. Now, looking at agriculture, I think this is thankfully one space that digital services cannot change because people still need to eat. Uh, so looking at government's focus on the rural economy, RBI talking about frictionless credit to farmers, the government trying to increase farm level income. I think all companies that service farmers will benefit, but again, it will not happen like in next 3 months or 4 months or 6 months. It could, but our bet is longer. We are looking at a 3 to 5 year multi-baggers coming from this space now.
Interesting. I heard you mention that by thematically you had bought into textiles, for example, and some of those bets have paid off handsomely up there. So kudos on that. What's
Thank
the call now that a bit of a rally is behind you?
I think, as I said, Neeraj, in this space, a lot of easy money has already been made through multiple re-rating. We haven't really seen very aggressive over the last 2 quarters, aggressive increase in earnings. It still has to play out. I mean, there are market expectations that earnings will grow with margins improving, volumes going up, US customers coming back, European customers coming back. So we understand that. I mean that would happen. Um, Again, like agrochemicals or agri sector, people still need to wear clothes. So the disruption by digital companies is not so much. Uh, but I think the multiple expansion has happened faster than we expected. So all the companies that we bought in March or earlier, first quarter this year, January to March, their multiples have doubled, in some cases more than that. So, for instance, companies like Gopaldas, again, not a buy recommendation. We have them in the portfolio, but a lot of them we have been booking profits now. The three stocks that we have in our portfolio have been booking profits because though they are long-term good stories, but still, if we have made significant money, I think it's prudent to take off some of that money and look at redeploying in other sectors. So that's what we are doing. We think over the long term, this sector will do well. But since easy money has been made, I think investors should, not expect miraculous returns over the next 6 to 12 months now.
Got it. Two or three other pockets of it. I'd love to have your views there. And since you spoke about easy money, right? IT services is one pocket, but the ER&D pocket, the companies, and today I was talking to LTTS just before our interview started, wherein they have also cut the guidance marginally, but the management is saying that we are just being cautious because there are a lot of moving pieces like maybe the United Auto Workers strike, and if that has an impact, so on and so forth. And my question is there too, after the bottoms got formed because of fear, there's a fair bit of buying that has happened in a LTTS, in a LXC, in a Persistent, in a KPIT Tech. So it's a small pocket, 4 or 5 companies, which are kind of trading at a divergent valuation and sentiment to IT services. What is your call here, if you have a thought?
I'm glad, Neeraj, that you broke it up into two parts, because I would have come to that. So you look at pure play IT services companies, the companies like, large cap and mid cap companies like, TCS, Infosys, Wipro, HCL Tech, LTI, Mindtree. Then you have the smaller companies there like Emphasis. These guys are largely, dependent on coding, app development. They're not so much of product companies, and that's the reason that these companies are struggling. And while a lot of analysts look at it purely from a poor demand environment, my view there is that these companies are suffering from low growth because they have not innovated. They have not come up with innovative solutions, products to give more efficiencies to their clients. And this is not limited to them. We look at companies like Accenture, IBM, Capgemini, international companies that provide. They have maybe slightly done better on the product side, but still the problem remains that customers are saying, I will give you a $200 million deal, but I want 20% more efficiency. And these companies still haven't figured out how do they drive that efficiency. You can't do that unless you innovate. So the model continues to be throw more people, more bodies, and look at the time and material pricing. I think that business has to completely restructure itself. So in IT services, I think that's what the concern is. That is why the guidance is 0 to low growth for the next 1 year. And I don't think that will improve till we see signs of some cannibalization of existing business and moving to a product mentality. The product companies on the other side that you mentioned, Neeraj, I think they are far more interesting. KPIT or LTTS and some of the other companies that are doing very good work on product side. So this is the other end of the spectrum, and I think the growth here, margins will be better than the traditional software service providers. So we are more bullish on these companies. We still think that the valuations have not corrected to the levels that we would like it to. But we have them on our radar, and I think if these product companies, come.
Sorry, we lost you a little, but you were talking about the product companies, Abhay.
Yeah. No, I'm saying that the product companies are the ones that are innovating. That is the more interesting end of the spectrum. If you look at companies like KPIT, LGTS, because these are using some product technology to bring efficiencies to their customers. They're creating a tangible ROI for their customers. So I think they have a much better opportunity to grow their revenues in well into double digits for next 5 to 10 years at attractive margins. So we are more hopeful about these product companies, software product companies, and software services companies. The valuations still stay elevated, not at a level that we would like to add them to the portfolio, but we have them on the radar, and I think at the right time we will add them to the portfolio.
Yeah, one final question, Abhay, and then the performance of some of the tire names. I'm taking very, very different pockets, but I'm inclined to ask that. And 5 consecutive sequential margin improvement shown by CEAT. At a point of time when crude has been so volatile or rubber prices have been, supplies have been volatile, there is some positive read-through for other companies as per brokerages too. What is your thought here on the tire names?
No, I think it's a very, very good space. I'm surprised that still the total market cap, if you put of all tire companies, Neeraj, is still very low. I don't remember the number, but we looked at it and we said, how can the tire company, if you have a growing automobile industry in the country, and whether it's an EV or a non-EV, everybody needs tires to drive on. So not getting disrupted, and there is now use of technology more and more because different vehicles need different tire solutions. 3-wheeler, 4-wheelers, commercial buses, trucks. So I think there also the companies need us that will innovate more in terms of product creation and reduce dependence on commodity raw materials will do better. And I think we are seeing early signs of that in form of CEAT and some of these other companies. In fact, I wouldn't be surprised if some of the Indian tire companies become global leaders based on their innovation, because some of the international companies that we looked at are kind of slowing down their R&D budgets, and they're becoming a little more complacent. So I think if Indian companies are hungry, which they are, I think finally we will see, over the next 5 years, a large international tire company coming out of India. I will not be surprised at all once that.
Well, that's our headline for the day, and we certainly hope that that happens. We've seen some fairly interesting international standard companies happening in India. Maybe it happens in the tire space too. But as usual, thank you so much for taking the time out and giving us a macro view and a nuanced view of specific pockets, which is why it makes it lovely to talk to you.
No, thank you, Neeraj, again for having me on the show. Great start to the day, by talking to you. Thank you so much.
Much appreciated. And viewers, thanks for tuning into this edition of the Talking Point.